Bob, let me start with you. I mean, I watched the eco numbers. I listened to the Fed speak. I sort of felt like I was going both ways at the same time. What did you see?
Well, for a bond investor, all of us who have been battered this year, this is one of the weeks that made sense to us. We had a nice tailwind coming in from the inflation data. It was great all the way through core. When you look at shelter, everything. Yes, the markets went a little crazy. They went wild. And the central bankers did what they're supposed to do. They came in one by one and reminded us, don't declare victory yet. These are only a couple prints. There are more hikes to come, but maybe there is some optimism. And the market settled down. So I look at this week and I thought, this is the first great week in a long time.
So Afsaneh, is that the way you saw it as well? And there's still some more rate hikes to come. How many?
I think at least another 3 to start with, 50 basis points next time in December, followed by at least 2 or 3 25 basis points next year. And then we'll see from there. And I think what Bob said is very true. At the same time, as we were listening to at least 3 Fed people come and speak, I wrote down, I think they all had very different quotes. And you had some of that when Lael Bernard talked. But you also had the president of St. Louis Fed say something slightly different, as if, you know, we would continue with rate increases for a while longer than she had implied. And then, of course, we had Susan Collins come in today with even, you know, sort of potential 75 basis points. So we're hearing numbers that are a little bit all over the place and trying to make sense of it.
So Bob, are the markets making it harder for the Fed as a practical matter?
They were at the start of the week. I think not so much now. I think we're all in the same spot. We've all got realistic expectations. The Fed's headed to 4.5%, 5%. They'll get there sometime in the first quarter. We'll see where inflation is. If it's below the Fed funds rate, then that gives them some scope to pause on the tightening. We can reevaluate at that point. But right now, bond yields have gone up a long way in a very short period of time. It's time for a breath.
Bob, does that get us to a soft landing?
Unfortunately, it does not. And I think that's the one consistent message from the Fed, Susan Collins aside, which is there is going to be pain for businesses and households. When you have this magnitude of rate hikes in such a short period, and you're also withdrawing liquidity through quantitative tightening, it's going to bite. And we're already seeing it's biting the economy hard. Thankfully, it's also now starting to bite inflation.
So I want to pick up on the liquidity just for a moment, if I could, Afsaneh. How big a problem do we have in the Treasury market now with the liquidity? I hear conflicting things, but some people are very concerned about it.
Big problems. I think Bob lives it much more than I do. But as you know, there are very, very big problems with the trading volumes. And for big traders or even small traders, getting bids is becoming much harder, and you're working in a much less liquid environment. And I know between Treasury and the banks, there have been a lot of meetings, but I'm not so sure if we have a solution yet.
Well, Bob, could the Fed make it easier with some regulatory changes?
It could, but I think the moaning that we hear in the bond market about liquidity, it's always there. We always complain we don't get the price we want. The reality is, for the last couple of weeks, you could have moved your portfolio in any direction you wanted, up and down duration, up and down credit risk without any kind of penalty. So I'm not that big a believer in the lack of liquidity.
Afsaneh, when we talk about a soft landing, it brings me back to oil, because oil did move this week, and it moved down in the price of oil. And most people I talked to suggested it was in part because of a concern about global recession, really a backing off or at least a softening in the markets. You came out of that business. You really know energy backwards and forwards. What are we seeing in oil?
So, as you said, oil prices the future numbers went down below 80, which was a big shift from a little while ago. But my view is still that we might just avoid a recession in the U.S. if we're fortunate, but we may not be able to avoid it in Europe and the rest of the world. And a lot of the, I think, softness for these numbers that we saw today and in recent days is because of the expectations in China. Now, China is starting to open up a little bit, maybe, and loosen its COVID rules. But that's going to take a while, and I think that softening is softening the oil markets, and will probably continue to do that.
Is it opening up? I mean, I'm not exactly sure of exactly what's happening because on the one hand, we hear them saying things that sound a little softer on zero COVID. On the other hand, we hear about a lot of cases.
So it is. It was kind of interesting. We had a team out in Asia this week, and they came back with interesting news that there is actually some physical opening up. But now you have people who are afraid to go out because they've been told so long that if they go out, they'll get COVID. And so you're seeing a very different phenomenon, which is actual, individuals not wanting to go out of their houses versus the government, which has been very strict about your getting out of your house.
Afsaneh, we also had the G20, of course, meeting over in Bali, and some people thought there would be no single statement coming out of it. They did come to some agreement, in part driven by some of the developing countries. Should that be encouraging to investors, actually, that we're getting back perhaps a little toward multilateral cooperation?
Much more positive news came out of the G20 than we all expected. And as you said, there was also a big stress on reform of the multilateral lending, because the big news out of that meeting was that there's huge needs when it comes particularly to emerging markets, climate-related investments, and there's no way with the existing finances of the multilaterals that could be met. So that was why there was a lot of emphasis on the reform of the multilateral sector, but also getting the multilaterals to work much better with the private sector to generate more resources. And you saw that very particular case of Indonesia, which was discussed a lot and written up a lot, with about 20 billion going into to replace coal in Indonesia with cleaner fuels.
Bob, another important development this week, it's sort of a rolling development, is the outcomes of the midterm elections. We found out that the Democrats will hold on to the Senate. The Republicans will get a narrow majority in the House. What does that communicate, if anything, to investors? Is that sort of a steady-as-you-go way because we have a split government, not much is going to happen either way?
So it for sure is. I will tell you, going back to the G20, we're actually hearing from clients, large institutional clients, that they're more confident about allocating to markets when the G20 countries are talking to one another again and working with one another again. So that's a huge positive. I don't remember that in, gosh, over a decade. When you go back to the gridlock in Washington, I hate to say it, but the markets kind of like it. It's when there are dramatic policy changes, you have to reprice everything in the markets. It becomes destabilizing. There are always going to be some winners. There are going to be some losers. This time, if we know we're going to have gridlock, we can focus on bringing inflation down and trying to avoid a recession and have a soft landing.
Yeah, I think a lot of people on the street think that it's sort of Hippocratic. First, do no harm. If you're not doing anything, you're at least not messing things up.